Welcome back, everyone. I am absolutely thrilled to have you here for a brand new explainer. Now, if you've been watching the charts lately, you already know that gold just printed an incredibly powerful bearish candle. I mean, it's the kind of move that literally makes you sit right up in your chair. But here's the fascinating dynamic. This is exactly the spot where the vast majority of retail traders get completely trapped, while the smart money, the massive institutional players, are already quietly positioning themselves for the real move. Today, we're going to break down the exact structural forces driving XAUUSD from the macro level all the way down to the micro levels, forecasting the week of June 8th through the 12th, 2026. All right, let's dive into this.
So ask yourself, are you falling for the retail trap? It's pretty much the ultimate pain point for anyone trading gold, right? It is just so incredibly easy to get caught up in the noise of those fake breakouts and sudden, jagged price spikes. Retail traders usually react to what the market is doing right this exact second, which almost always means they're late to the party. Our goal in this explainer is to completely demystify the complex, invisible forces driving gold right now. We're going to clear away the fog and give you a crystal clear roadmap for the week ahead so you can trade based on logic and structural momentum rather than just pure emotion.
Here is how we're breaking it all down today. First up, the macro forces driving gold. Second, we'll do a multi-time frame technical analysis. And third, we'll lay out the weekly trading plan.
Let's jump right into Section 1, Macro Forces Driving Gold. We need to understand the deep structural momentum first.
To establish some order out of this chaotic global economy, we are focusing on three core pillars. Force 1 is US dollar dynamics, specifically the DXY. Force 2 covers geopolitical risks. And Force 3 is institutional activity. You guys, these three forces are perfectly aligned right now, and understanding how they interact together is going to give us a massive edge.
What's really interesting here is the number 100. This refers to the US dollar index, or DXY. Look, the dollar remains the absolute most important counterforce to gold, period. Right now, on the weekly chart, the DXY is stuck in this broad consolidation range between 96 and 100. But recently, we saw a massive bullish candle that completely swallowed up the indecisive price action of the previous 2 weeks. Buyers are aggressively taking control here, and they are making a highly concerted run to push above that major psychological resistance of 100.
Now, you might be wondering, could the DXY just fail at 100 and reverse lower like it has so many times before? Well, yeah, it's definitely possible, but consider this figure. 4.5%. This is exactly why the probability of a breakout is significantly higher this time around. The DXY has powerful, undeniable support from rising U.S. 10-year Treasury yields, which are holding firmly above 4.5%. When yields are running that strong, it acts like a massive tailwind for the dollar, seriously increasing the odds of a successful breakout above that 100 mark in the near term.
And this brings us right to our second macro force, geopolitical risks. We always look at this impartially, just to understand the market flow. Currently, ceasefire negotiations between the US, Israel, and Iran are active, though the situation remains super fragile. Meanwhile, peace talks between Russia and Ukraine are showing some progress, but we still don't have a concrete resolution. So the takeaway here is this. While these ongoing geopolitical tensions absolutely build a long-term structural floor for gold, right now, they are simply not strong enough to offset the heavy short-term pressure coming from a stronger US dollar.
Let's move to Force 3, and honestly, this is a staggering figure, -9 tons. This represents our institutional activity. Just last week, the SPDR Gold Trust sold off an incredible 9 tons of gold. That's massive. Remember, while retail traders are stressing over every little tick on the 5-minute chart, institutional flows are positioning weeks ahead of major market shifts. A sell-off of this magnitude is a flashing neon signal. It clearly tells us that the smart money is anticipating a much deeper correction in gold prices from current levels, especially if that US dollar index keeps flexing its strength.
Let's actually pause for a second and really absorb this quote from our source material. When institutional capital starts rotating at this scale, the market is usually preparing for a larger move ahead. This shift is absolutely not random. It is a highly calculated move driven by the exact alignment of the dollar dynamics and the geopolitical state we just talked about. The macro forces have set the stage perfectly. But to find our exact entries and exits, we have to look for confirmation in the price action.
Which brings us to Section 2, multi-time frame technical analysis. We're zooming into the charts now. Oh, and by the way, a massive congratulations to those of you who banked over 5,000 pips from our April 11th setup. What a run.
Starting off with the broader weekly chart, gold closed out with a tremendously strong bearish candle right near the critical 4,300 support level.
More importantly, it closed well below the prior week's bullish pin bar, which just screams that selling pressure is entirely dominant right now. Now contrast that with the daily chart. Gold remains firmly locked in a bearish trend. The momentum is so heavy here that there is actually an elevated risk of a bearish gap right at the market open next week. So both time frames are telling us the exact same story. The sellers are entirely in control. Let's dial it down to the H4 chart to refine our timing. On this time frame, gold is actively trading inside a descending channel and is currently testing that 4,300 support area, which perfectly lines up with the lower boundary of the channel. Because of this structural confluence, we might actually see a short-term technical rebound, maybe pushing price back up to the 4,350 or 4,370 region. Actually, scratch that. Don't be fooled by it. Unless buyers generate some massive, unexpected momentum, this is highly likely just a quick breather before the broader decline down toward 4,200 resumes.
Okay, Section 3, the weekly trading plan. Let's get into the exact actionable levels for June 8th through the 12th, 2026.
Let's carefully walk through these sell zones. Zone 1 is our premium daily institutional resistance, sitting up between 4,430 and 4,500. A logical stop loss goes just above that at 4,502, with a first target scaling down into the 4,400 to 4,300 range. The extended target reaches all the way down to 4,200 or even 4,000. Now, if price doesn't make it quite that high, we have Zone 2. This is the nearest high-probability 4-hour resistance between 4,340 and 4,400. You'd place a stop loss at 4,402, targeting the 4,300 to 4,350 block initially, with that exact same extended target of 4,200 to 4,000. These are the primary zones where we want to watch closely for bearish confirmation.
Now, despite the immense bearish pressure we've been talking about, strong recovery rallies are still possible. But, and this is a massive but, guys, these remain viable only while the DXY holds below that key 100 resistance level. If you are determined to buy the dip, here are your zones. Zone 1 is deep weekly institutional discount support between 3,900 and 4,055, with a stop loss down at 3,887. Zone 2 is a closer daily high probability support between 4,100 and 4,255, stopping out at 4,087. These areas offer fantastic risk to reward for relief bounces, but you absolutely must keep one eye firmly glued to the US dollar.
Before you go setting any pending orders, consider this absolutely critical risk management pro tip from the source material. A false breakout is when price moves through a level but completely lacks the momentum to maintain its direction. Do not get caught trying to anticipate a breakout. Professional traders always, and I mean always, wait for a retest to confirm that the level has officially flipped before entering. Please make sure you adjust your stop loss levels based on your own personal risk profile. Survival is always rule number one in this market.
So, let's distill all of this down to our overarching base case. If you remember absolutely nothing else from today's explainer, please remember this. As long as the DXY holds strong above 99 and U.S. Treasury yields continue their upward trajectory, the path of least resistance for gold is overwhelmingly down. It is heading steadily toward that 4,200 level. That is the fundamental truth driving these charts right now.
Which brings us right back to where we started, leaving you with this final, provocative thought. Will you react emotionally this week like a retail trader, just blindly chasing green and red candles? Or will you patiently position yourself at these key macro and micro zones like an institution? The choice is entirely yours. To help you stay on the right side of the market, we publish these key levels in real time, and you can find the Telegram link below to stay updated throughout the entire week. Trade safe, manage your risk, and I will see you in the next explainer.